Technical analysis is defined as the art of forecasting price movements in the future, based on price actions of the past. The main tool for technical analysis is the price chart, which is a graphic representation of the price of a certain instrument, such as a currency pair. There are a number of ways to display price action on a chart, each way providing its own unique benefit, and we'll begin this video by quickly introducing a few of the more popular chart types. This is a daily line chart of the euro-dollar for the months of July and August in 2008. It's called a line chart because it's generated by connecting the day's closing prices with a line. It's meant to offer the trader an easier way to judge the trend of a currency pair than by simply looking at a table of prices. Here's the same euro-dollar data displayed on a bar chart. Bar charts visually depict the high, low, and closing price of each session. Traders use this information to note potential reversals on the chart, which may be easier to see than it would be on a basic line chart, which only shows closing prices. Finally, here is a candlestick chart, showing the same price data as our previous two examples. This chart adds more information in that one can see the open, high, low, and closing price of each session. Traders can also get a better feel for the sentiment of the market, since each candle clearly shows whether the session was an up day or a down day. An up day is when the closing price was higher than the opening price and is noted by a blue candle. A down day is when the closing price was lower than the open price and is noted by a red candle. Because candlestick charts provide the most information about price history, over the years this chart type has become a staple tool for many traders compared to bar charts and line charts. And we'll focus the remainder of this video on candlestick patterns for this very reason. From our brief introduction, we know that candlestick charts provide more information than both bar and line charts. However, more is not always more. A more compelling argument for using candlestick charts is that candles provide unique visual cues that make reading price action easier. These visual cues allow speculators to better comprehend market sentiment. Offering a greater depth of information than traditional bar charts, where the high and low are emphasized, candlesticks give emphasis to the relationship between the open price and the close price. Traders who use candles have the opportunity to identify different types of price action that may offer a clue about a potential reversal, one of the most difficult aspects of trading. Furthermore, combined with other technical analysis tools, candlestick pattern analysis can be a very useful way to select entry and exit points. The body of a candle illustrates the difference between the open and closing price. Its color, in this case blue for up and red for down, shows whether the session closed above the open or below the open. The wicks, or shadows, point out the extreme low and the extreme high price for the currency that session. Because the body of the candle is thicker than the wick, candlestick charts visually stress how the close price relates to the open price, far more than bar charts, and it does so purposefully. Candlestick traders have a saying, "The real body is the essence of price movement," meaning the relationship of the open price to the close price, more often than not, provides the clearest picture to future price action. Bar charts, on the other hand, allow spikes to highs and lows to have prominence. When exploring their data, these highs and lows often represent market noise, often less significant to good analysis. For example, assume a major corporation like Microsoft came into the market, executing millions or even billions of euro-dollar exchange within a short period of time for overseas business purposes. The market price could certainly jump to an extreme high or low, but this wouldn't say much for the overall direction of the euro-dollar rate in the medium to long term. In fact, it's likely that the close for the session would not be near the extreme high or low, as we would expect prices over time to adjust back to their normal levels. The power of candles is in their ability to visually screen out this noise, allowing traders to focus on what many find to be the most relevant price data. One of the most significant goals of technical analysis is to identify changes in direction of price action. Because candlesticks give insight into what the market is thinking, one of the most useful aspects of candlestick analysis is the ability to suggest changes in the sentiment of the market. We call these candle formations reversal patterns. There are a number of reversal patterns in Western technical analysis, such as head and shoulders and double tops. Those formations often don't give much insight into what the market is thinking. They simply represent common patterns found in price action that precede a reversal. Reversal patterns in Western analysis often take many periods to form. On the other hand, candlestick interpretations concentrate much more on understanding market psychology than anything else. And because the vast majority of candlestick formations form over the course of just 1 to 3 completed candles, they give traders a more real-time or current picture of market sentiment. It's important to note that with candlesticks, a reversal pattern does not necessarily suggest a complete reversal in trend, but merely a change or pause in direction. That could mean anything from a slowdown in trend, sideways trading after an established trend, or a full turnaround following a reversal candle pattern. While candlestick formations have no predictive ability at all, they're quite valuable in helping the trader better time their entry and offer placement for their initial protective stop. Let's take a look at some examples of how to use a few of the more popular candlestick formations in a trading approach. We'll begin with 3 candle formations traders can watch for as the market moves towards a support level. We'll then follow with 3 formations to watch for as the market moves towards a resistance level. All of the examples that we'll look for in this video show candle formations around support or resistance when the market is trending, but you could also watch for these formations as price action moves towards support or resistance in a range-bound market as well. First, we have the morning star. Morning star patterns establish over the course of 3 candles. The first candle closes down with a continuation of the bearish move. The second candle sees a continuation of the move down, but a rally makes the market close at or near the open for the day. The second candle weakly suggests a loss of bearish momentum. The trend reversal should be confirmed by a blue candlestick on the 3rd day. The higher price is able to move up on day 3, the stronger the reversal signal. With this pattern, watch for rallies after day 3. Entry would be at the open of candle 4 after the formation is completed, with a protective sell stop below the low of the morning star. The second candle formation to look for around support levels is a bullish engulfing candle formation. The bullish engulfing is one of the more obvious 2-day bullish reversal patterns. The formation reflects buyers overtaking selling strength and often precedes a continued rally in price. The smaller the first day's candle is, and the larger the second day candle is, the stronger the potential of a reversal. Small candles reflect uncertainty in the market's trend. Thus, the smaller the candle on the first day, the better the chance of an end to the move down. The second day bull move acts to confirm the reversal of the move down. A big blue candle reflects a strong rally, and the better the chance of a reversal. Entry would be at the open of the next candle after the formation is completed, with a protective sell stop placed below the low of the bullish engulfing formation. And finally, our 3rd candle formation to watch for around support levels is a piercing line. The market continues the downtrend on the first day as candle 1 closes down. By the second day, buyers take the price up so the close is near the open of the first day. Most traders view a lower low on the second day as better, since the strong selling after the open, the more buyers were able to push the market back up. The formation suggests that buyers have begun to take charge of the market, and sellers have been shaken out by the sudden loss of bearish momentum. Uptrends are common after this formation as more buyers confidently enter the market with a clear protective stop level just below the lows of the formation. However, some traders wait for further confirmation regardless of how far the piercing line penetrates the second day. They would look for another up day and buy on the open of the 4th candle. Protective stops would then be placed below the lows of the formation. Now let's turn to 3 candle formations to watch for as price action moves up towards resistance. Again, we'd want to watch for these candle formations when there is a short-term reversal to resistance in a downtrending market, or a move up to resistance in a range-bound market, when at the same time price action suggests further downward movement is likely. Then and only then will these candle formations become relevant. First, we have the evening star. Evening stars start with a continuation of a bullish move as candle 1 closes up. The second day sees a continuation of the move up, but a sell-off makes the market close at or near the open for the day. The second candle suggests a loss of bullish momentum. The trend reversal should be confirmed by a red candlestick the next day. Thus, bearish evening stars require a sharp sell-off after the market open on day 3. Analysts want day 3's high to be near or equal to its opening price, suggesting the market's sell-off has no uncertainty in the new direction. With this pattern, watch for sell-offs the following days. Entry would be at the open of the next candle after the formation is completed, with the protective buy stop placed above the high of the evening star. Next we have the bearish engulfing. The bearish engulfing, like the bullish engulfing, is one of the more easily recognizable two-day bearish reversal patterns. The formation reflects sellers overtaking buying strength and often precedes a fall in price action. The smaller the day one candle is, and the larger the second day is, the stronger the potential for a reversal. Small candles reflect uncertainty in the market, thus the smaller the first day candle, the better the chance of the end to the move up. The second day bear move acts to confirm the end to the move up. A bigger red candle reflects a stronger sell-off and a better chance of a reversal. Entry would be at the open of the next candle after the formation is completed, with a protective buy stop above the high of the bearish engulfing formation. And finally, we have the dark cloud cover. On the first day that a dark cloud formation begins to form, the market continues in an uptrend towards resistance. By the second day, sellers take the price down to close near the open of the first day. Traders view a higher high on the second day as better, since the stronger the rally after the open, the more sellers were able to push the market back down. This formation suggests that sellers have begun to take charge of the market, and buyers have been shaken out by the sudden loss of bearish momentum. Downtrends are common after this formation as more sellers confidently enter the market with a protective sell stop just above the highs of the formation. However, again, some traders wait for further confirmation regardless of how deep the dark cloud cover penetrates the second day. They would look for another down day and sell on the open of the next candle. Protective stops would then be placed above the high of the formation. As we mentioned earlier, candle formations have no predictive ability to forecast future price moves. But if we locate candle formations in the right place at the right time, they can offer value in identifying entry and exit levels. But first, a trader must identify the trade setup and look for candle patterns that are relevant to that particular setup. So let's wrap things up by looking at two typical trading scenarios to make sure we know how to properly identify when to look for different candle formations. We identify a buying opportunity as a move down off of a high to a support level when the market is in an uptrend. In this example, we can see that playing out, and if we now see a morning star, bullish engulfing pattern, or a piercing line formed at support, we have our entry and initial protective stop placement. We could buy on the open of the next candle after the formation is completed and place our protective sell stop below the low of the formation. But the important thing again is we're looking for that initial time where we should be looking for these candle formations. In this case, the market moved down to the support level. That's when we found our formation to give us our entry. Here's an example of a selling opportunity. We define this as a rally up to resistance when the market is in a downtrend. If we then see an evening star, a bearish engulfing pattern, or a dark cloud cover at resistance, we have our entry and our exit identified. Again, we could sell on the open of the next candle after the formation is completed and place our protective sell stop above the high of the formation. Most importantly, the thing we're trying to point out here is that these candlestick patterns become relevant only at certain times. By following these basic but timeless rules to recognizing trade setups, we can then use the candle formations as they were designed. There are literally hundreds of candle formations that traders can use. We only covered a few of the more popular ones here. A more complete list can be found by visiting www.fxwords.com and searching for Japanese candles. You can also find lots of relevant information at DailyFX and the DailyFX forums. DailyFX analysts often incorporate candlestick formations into their analytical reports. This is a great way to learn from the pros and continually develop a keener eye for recognizing candlestick formations. We hope you enjoyed this introduction to candlestick formations. Good luck with your trading.